Hi, and welcome to Chapter 10, Fixed Income Securities. So this chapter is all about bonds. So you might be asking yourself, why should I invest in bonds? Well, because bonds have a different risk profile than stocks. Bonds provide income and can be a good long-term strategy for generating income and savings for retirement. Now, what basically are bonds? Bonds are publicly traded long-term debt securities, meaning greater than a year in length, and they're issued by lenders who would like to raise some money today in exchange for periodic interest payments, and then finally, with the principal being paid back in full at maturity. So that's why, since you get these routine interest payments, that's why we call it a fixed income security. So the issuer, sometimes we refer to as a borrower, is going to pay a fixed amount of periodic income or interest to the parties that buy the bond. So a lot like stocks, bonds are can have current income. So both stocks and bonds can pay dividends, but only bonds pay a more reliable steady stream of dividends, where stocks are not as well known for their dividend income. Bonds can also result in capital gains. So you can buy a bond at a discount, and then when the bond matures, you can sell it at a capital gain. Or actually, you can sell the bond anytime this life may have got to a point where it's priced higher than when you originally purchased it at, and that would be a capital gain. So we'll talk about bond prices, returns, and interest rates, and the risks of bonds as we move through this chapter. Okay, so let's talk about a history of bond prices, their overall returns and interest rates in the next couple of slides here. So when we talk about interest rates, this is the most important thing when it comes to bonds. We have two directions interest rates can move in. Interest rates can move up or interest rates can move down. So if interest rates rise, bond prices fall. And if interest rates drop, bond prices move up. So that's an inverse relationship. So let's talk about why that relationship exists. Okay, so think you have a bond that pays 10% interest. Okay, so if interest rates rise to 15% interest on similar bonds, your bond is not as valuable now because someone can just buy a new bond at 15% interest rate. So your bond at the 10% interest rate, the bond price has to fall. So when we say bond price, that's the price you pay for the bond. So if I buy a $1,000 bond, interest rates move up. Now my bond might only be worth $900 because it's old and busted. It's not as good as the new bonds paying higher interest rates. Let's say that interest rates drop. So the average interest rate for similar bonds with similar risks goes from 10% to 5%. So if I'm holding a bond with similar risks profile and it's paying 10%, my bond is more valuable. That means I could probably sell it for $1,100, maybe $1,200, which is up from the $1,000 I originally paid for it because interest rates fell. So this is the inverse relationship when it comes to interest rates and bonds. So you want to buy bonds when interest rates are dropping, and you want to sell bonds when interest rates are rising if you're trying to trade for the capital gains. So keep that in mind. Bonds have two ways of making money: interest payments, which are dividends, or capital gains, where the bond price changes. So it's much like stocks in that way. Now, corporate bonds are very popular. Government bonds are even more popular, but they tend to move together as far as increasing bond rates or decreasing bond rates, increasing bond values or decreasing bond values. And they move together because both government and corporate are tied to the current interest rates. Now, keep in mind that corporate bonds typically are more risky than government bonds and have a higher rate of interest than government bonds. Now, when you look at the difference between say a 30-year corporate bond and a 30-year government bond, that's going to be called the spread. So if you take the corporate bond rate and subtract the government bond rate, you get the yield the yield spread, sometimes called the credit spread. So let's look at these spreads. Now, the blue is the AAA corporate bond yield, and the red is the 10-year Treasury bond yield. So you see that for most of the time, the corporate bonds are trending above the government bonds. At least you can see this trend has been this way all the way back to, say, 1982. Even 1982, the only time where it was inversed was back in 69. And that was a whole different dynamics. Back in 69, the U.S. government actually had not a deficit, but was running a surplus for the last time. Okay. So let's talk about history. So now we just saw that slide. Let's talk about the history of bond prices and historical returns. So the total return on the bond is going to depend on the direction of interest rates, as we've been talking about. So as I explained before, when interest rates are increasing, the total returns on bonds, including capital losses, can sometimes exceed the bond's interest income, so resulting in a negative return. So if the overall bond price decreases in value by more than the interest the bond pays in a year, then you have a negative return, which is certainly possible. And U.S. Treasuries have had negative returns in 10 out of the last 55 years. So it's quite possible for bonds to have a negative return. So if we look at this chart here, we can see from 63 to 76, we can look at the beginning of the year bond yield, end of the year bond yield, and we can see how the bond yields change. Now, the total bond return, you can see here 67, 69 were two negative years, and also 1980 and 1987, as well as 78. So it can occur. And there can also be some fantastic years of returns. If you look at 82, a 35% return, 85 and 86, double-digit returns there, and 89. So Treasury bonds can have sometimes some fantastic total returns. All depends. In this time period, specifically from 77 to 90, interest rates were highly volatile. They've been a lot less volatile currently. So what you could see in the returns of the last 18 years or so, they've been not as aggressive as, say, the early 80s. But there have been years where bonds have returned to negative, and most years where they've returned to positive. So bonds in general have less of a risk than stocks as far as the volatility or the standard deviation of return, which is why people think of bonds as being safer. And bonds generally, most statistical looks at bonds show that they are safer statistically, and that's one of the reasons the overall return on bonds are lower, because of the reduced risk. So this inverse relationship that I've been talking about between bond prices and yields, this could work in investors' favor. So if we looked at the years of the highest total return on bonds, there are always years in which bond yields fell during the year. So remember, if we go back to, say, 1980, look at these bond yields. Excuse me. We're looking at bond yields that are pretty significant throughout these years. And as we move into the later years, we see that starting in the 90s, we have a continual drift lower of bond yields. So even if we extend this till today, we see that Treasury bond yields are, under 2%. And this has been what a lot of people call this long-term bond bull market, where there's been a continual decline of inflation and interest rates over the last 30 years that have greatly increased the returns of bonds for that time period. And it goes to show you when a asset class like bonds goes into a bull phase, that could last multiple decades, if not multiple years. So you can see how bonds are good investments. The question today is, well, how much longer do bonds have, considering interest rates, in some cases getting close to zero, and in some cases negative? Where can bonds go in the future to find significant returns for the investors? That's a big question that the investors have. Should I stay in bonds? Now, if we look at bonds versus stocks, so when we compare stock returns to bonds, bonds generally offer lower returns than stocks. But we can find the benefits in bonds because we get lower risk, higher levels of current income, and also additional diversifications. So for most people, we're told 60-40 was a good portfolio of stocks and bonds. 60% stocks, 40% bonds was a good way of bringing diversity to your portfolio and extra income to your portfolio. That percentage, 60-40, was around for a long time, but some thinking is changing on that. Let's look at performance of stocks to bonds. This is only going, I wish this went to, into the 2020s, but it only goes to 2017. So here we have, this blue line is just the total bond index. You see how this does move higher. We have some ups and downs, but nothing compared to the stock market. For the most part, the stock market, since 94, the stock market has operated in these bull and bear markets where we move up, have a significant correction, move up, correction, move up. So stocks have certainly returned a significant amount of money over this 30-year time period compared to bonds, but bonds has been sort of this slow and steady tortoise of a return. Still a decent return, but without the extreme volatility of the stock market, which some people find very unsettling. Now, let's talk about the 5 major types of risk for bonds that bond investors should worry about. 1, interest rate risk. So if interest rates do go up, and this is a possibility if economies get overheated, the reserves across the world generally push up interest rates. And when interest rates are increased, that's going to negatively affect the bond's value. Now, purchasing power price. So this is the chance the bond yield will lag behind inflation rates. So if inflation goes up, it's overall very bad for bonds, especially if inflation is larger than your income. So if inflation is 5% and your bond is paying 3%, you're basically losing money when you look at the power of that money. That's why raising interest rates are very bad for bonds in general. Luckily, we've been in an environment where interest rates have been stable or falling over the last 30 years, which has made bonds be a very attractive investment in that time period at a low risk. Now, if you're invested in corporate bonds, you have this business/financial risk. So if the corporation you're buying a bond for, if their business fails, maybe it's disrupted by new technology, or if they have too much financial risk, meaning they borrowed too much, then you have a risk that your bonds will be defaulted on, which means that the company may just stop paying interest on your bonds, or they may refuse to pay the principal back. So that's definitely a risk you take with corporate bonds. If the company is not available and active in earning money, they're not going to be able to, in some cases, pay back their requirements of income and principal. There's also liquidity risk. So this refers to bonds that might be difficult to sell or have a very thin trading market, and to sell it at a reasonable price. So there are some bonds. Bonds generally tend to be overall a very liquid market, especially treasuries, especially big corporate bonds. But there can be some bonds, smaller, less known corporations or smaller countries that offer bonds that may not be as liquid. It may take more time to sell. And there's a call risk. And this is a risk that the bond is going to be retired before it matures. So much like you may want to refinance your your auto loan, your student loans, your mortgages, because current interest rates are lower and it makes it advantageous for you to refinance. So do corporations. So if interest rates go down significantly, a corporation may decide, hey, I'm going to call the existing bonds, borrow new money at lower rates, pay off the existing bonds, and now I have just saved myself a bunch of money by refinancing. Okay. Now, bondholders, meaning when I say bondholders, that means you as an investor buying a bond. That would be you, the bondholder. Now, you're not an owner of the company. So unlike stocks, you're an owner and you have rights to vote. Bondholders are not owners, so they have no voting rights. Bondholders do have a right to be paid interest in their principal. There is a maturity date at which the bond matures. The the principal is paid back. Bonds are quoted just like stocks are quoted. They have in some cases, a bid and an ask. Stocks could have, call features, a sinking fund, secured or unsecured debt, and bond ratings. So on the next series of 14 slides, let's look more closely at these topics. Okay, so let's get the very basics of bond interest and principal. Now, the coupon is the amount of annual interest income a bond's going to pay. Why do we call it a coupon? Well, long time ago, before the invention of computers, bonds were around before computers. And when you bought a bond, you got a coupon book, and you would go to the bank at the end of the month or whenever the coupon was due, and you would rip the coupon out of your coupon book and present it to the bank. They'd validate it and put the interest in your account. So that's why they call them this annual interest income, a coupon. Principal. So this is the par value or face value of the bond. This is the price of the bond when it's born, and the price that's going to be paid back to the borrower when the bond matures or dies. Now, the par value for bonds are very important. Unlike the stocks, in the stocks, par value means really almost nothing. But for bonds, par value is very important. That's the face value. And some people have made quite a money buying stocks below face value or par value, and then waiting for them to mature to receive the full value of the bond. Now, coupon rate is going to be the annual coupon divided by the bond's par value. So if a bond pays $100 a year in interest and the bond is a $1,000 bond, that's a 10% coupon rate. So it's a very simple expression of the interest payments as a percentage of par value. Most people, when you buy a bond, it will not be at par value, but somewhere below or above par value, which we'll talk about later. The current yield. So this is what's really important to you. What is the current yield on the bond, which can be different if the par value of the bond price changes. So the interest can remain the same at $100 because interest doesn't change. Once they have a stated coupon rate, that's not going to change. So we'll stay at $100. But the bond may actually increase or decrease in the face value. So if you take the 100 and you divide it by, say, a new face value of 900, you're going to get an interest level that's higher than 10%, than the coupon rate. So the current yield can move up and down as the bond's par value or face value moves up or down. Now the maturity date. This is when the bond is basically, we say, due, and the principal must be paid back. So if you have a 30-year bond that opened up on January 1st, 1990, then December 31st, 2019 will be its 30th year in operation, and the bond will have to pay you back. The company or the corporation or the government that issued the bond has to pay you back the par value of that bond. Now, the terms of the maturity, the amount of time left on the bond before it matures. So you have the life of the bond, which could be a 30-year bond, but when we say term to maturity, this is the amount that remains. So maybe 14 years left on the bond, and it's lived 16 years already. Now, the term bond Now, this is a bond that is issued and has a single maturity date. Most common bond around. So it's issued at $1,000, and it's at the end of the bond, it pays $1,000 back. So at one single maturity date. A serial bond is a bond that has a series of bonds at different maturity dates. So this is a bond that's going to have, going to mature a number of times within the bond offering, which means that it's basically saying that it's going to have certain percentage of the bond will mature, be paid back to the bondholder over the life of the bond. And that could be, 10, 15, 20, 30 in a single bond offering. So it's sort of like, if you're having a hard time thinking about what a serial bond is, from the bank's point of view, a mortgage or an auto loan is like a serial bond where they get paid back every month that you're paying those auto loans and home loans. You're paying back principal and interest. So serial bonds will pay back some principal and interest every year for some of them. Now, a note, this is a debt security that has a maturity between 2 and 10 years. So bonds typically are greater than 10 years. So we would say something is a note, like a Treasury note, if it's in between 2 and 10 years. So it's just denoting a shorter term bond. Now, let's move back to bond price behavior. So the value of the bond is really a function, of course, of the risk. But specifically, we want to look at the bond's coupon, its maturity, and the level of interest rates. So how valuable is a bond? If you want to calculate what is the value of this bond I hold today, you would look at the bond's coupon rate compared to the market interest rates and the number of years left of maturity. Now, if a bond is in a position where it's valued above its par value, we call that a premium bond. And this usually occurs when interest rates drop. We have more bonds that trade above their par value and become a premium bond. A discount bond is when a bond is going to sell less than its par value. So if interest rates move up above the bond's coupon, the bond is going to have to discount to remain comparable. So this discounting is what creates liquidity. So if your bond wasn't able to discount its par value to make it competitive, because when your par value goes down in relationship to your coupon, your current yield goes up. So your current yield would need to match that of new bonds. And that's what keeps bonds liquid. Now we look at the maturity. The maturity of a bond has a greater impact on price volatility than the coupon does. So this is how to express this. When a bond is just born and has the longest maturity you'll ever have, that first day that it's on the markets, it's going to be more affected by interest rate changes because it has more of a lifetime to have their income compared to interest rate changes. If a bond is going to, say interest rates doubled, but the bond is going to mature tomorrow, it's not going to matter much that the interest rates went up or doubled because tomorrow is the day the bond dies and pays back the par value. So you don't have a lot of time to earn that extra interest. But if interest rates double and bond has 30 years to mature, then the par value is going to have to go down greatly to discount the bond to make it equal to the current interest rates. So that's why bonds with longer lives have a greater fluctuation on its face value than bonds with shorter maturities because of the time left to collect interest. So let's look at this in the graphic. So this is it's hard to comprehend this. So I think the graphics sometimes help with this. So let's look at a discount bond. So we're going to start at year 0, where all these bonds are born on their first day at $1,000 par value. Now, these bonds are 20-year bonds. Let's look at what happens when there's a change in interest rates. So here are the market rates changing. So if we look at the years of maturity left, so a bond that's born today is worth $1,000 and it has 20 years maturity left. So let's look what happens with the bonds. The bond's born at 10%. So the price of 10% bond yields 10%. So the par value of the bond is $1,000 and it pays a 10% coupon. If interest rates start going down, so current interest rates, the new bonds are only offering 8%, your bond is paying 10%, you're going to have a premium price of say around $1,200. So that means you've made $200 on your bond because interest rates move down to 8%. But if interest rates go up, so the new bonds are offering 12%. So say tomorrow the interest rates went up to 12%, your bond would have to be discounted to about $850 to compensate for the fact it's only paying 10% where the new bonds are paying 12%. So this blue line and this dotted red line will show you if bond prices are 10%, but the current yield is at 12%. Over time, you get the greatest change here when it has 20 years left to live. When there's only 5 years left to live, the bond doesn't discount to $850, it only discounts to about $925 because there's not that much time left to live. So when you actually reach the end of the bond's life, it doesn't matter where interest rates are, so the bond's par value is going to be close to its face. The bond's selling price will be identical to its par value because of the fact that, I wouldn't say identical, it depends on how many days till it matures, but it's going to have less of an impact. So this range here gets more narrow the fewer days you have. So I guess you could kind of think of it as if your bond has 20 years to maturity versus 15 years versus 10 years or 5 years left versus 0 time left, that it's going to have less of an impact on the actual bond price when we're only days away from its maturing. Now, as far as the quoting of bond prices, they're not as easily accessible as stock prices are. Stock prices are everywhere and on thousands of websites and in newspapers. Prices of bonds are expressed differently. And they're not, you can look them up, certainly, but they're not going to be as easy to find as stocks. Why? Because people aren't, one, checking their bond prices every day. They don't really move that much. And two, overall investment interest in bonds is not as high as stocks. And bonds are expressed as a percentage of par. So when we look at a bond quote, it's going to be a percentage of par. So if the bond quote is 100%, it's trading equal to par. Now, and this percentage is expressed as a decimal, not generally as a decimal. So if the quote is 87.56, that's going to translate as 87.56% of the par value. So if the par value is 1,000, the bond's going to be at $875.62. So we always quote by our percentage, not the actual. Why do they do that? I'm not exactly sure, but it might be for ease of spacing, but bonds are always a percentage of the par value. Now, in the U.S., the Treasury and agency bonds are quoted in 30 seconds of a point. So 1 point equals $10. So if a T bond is 94.16, that translates to 94 and 16 30 seconds, or 94.5% of par. It's just something that's left over, this fractional trading, that stocks used to be traded in fractions as well. So it's still kind of a leftover, but that can easily be converted into dollar amounts. Okay, and now the bond price, of course, depends on its coupon and maturity. And if you have, hopefully, if it's a good site that's quoting the bond, they include both of those in the quotation. Okay. Now let's talk about the call feature. So, like I explained earlier, think of the call feature as the corporation, the government saying, "Hey, bond, I'm calling you, come home." And what it means is they basically want to retire the bond so they could refinance at a lower interest rate. Now, investors hate this. So sometimes they create what are called call features to help reassure bondholders about early retirement. So if the bond is freely callable, that means it can be retired and refinanced at any time. So that's risky for investors. If a bond is non-callable, it's prohibited from being retired prior to the maturity. So this is an advantage for bondholders. It means that they can't have a great yield and suddenly it's refinanced. A deferred call gives a timeline, so it can't be called until some time has passed. So you could get a bond with a deferred call of 10 years, meaning 10 years have to pass before they have their first chance to call the bond and refinance. So these if you have these call features which are benefiting you as a bondholder, then the bond pricing is going to be the yield on those bonds are going to be a little bit lower to denote this favorable call feature. So that lower rate of return is a reflection of less risk when the bond isn't callable. Okay, so of the call features, we have a call premium. This is an amount added to the bond's par value and paid upon call to compensate bondholders. So meaning that if they're going to call the bond, they might say, okay, your bond is $1,000 par value. We're going to pay you a call premium of $100 to compensate you for calling the bond early. That's a nice feature to have. There could also be a call price, and this is the bond's par value plus the call premium. So we would say this bond is a par value of $1,000, but a call price of $1,100. There's a refunding protection provision, and this prevents borrowers from using the proceeds of new lower coupon bonds to pay for the cost of calling the outstanding bonds. So this is a way of saying that, make it a little bit more of a deterrent for the corporation or government to call the bonds and reissue them, because it makes it prevents them from using that new bond to help refinance the old bond. Okay, and this is one of the ways that if you ever refinance your mortgage, the bank makes it seem like you're saving all this money, but the bank is actually taking part of the refinancing proceeds for themselves. So you don't really understand how the bank profits from this, but you're not getting the full 100% benefit of the refinancing because the bank is keeping some of that benefit for itself. Okay, let's talk about a sinking fund. This is not that common, but it's kind of making sure that it has to deal with the principal. So it's how the bond is paid off over time. And of course, this is not going to be, it mostly applies to term bonds, if not exclusively to term bonds. And what it's basically saying is that, although not all term bonds will have this requirement, but it's basically saying that, at a certain point after the date of issue, the principal, part of the principal will be paid back with the interest. And then when the bond is retired, you get a balloon payment of the rest of the bond value at the maturity. So this is a way for an issuer to systematically pay back the bond over time, and makes the bonds less risky because you're receiving your interest plus your principal along the life of the bond. So that way, because a lot can happen in 30 years. A company can go bankrupt within those 30 years and you never get back your par value. However, if you have a bond with a sinking fund, you're going to be receiving principal over time. And that way, even if if the corporation goes bankrupt in, say, year 29 out of 30, if you had this sinking fund or a term bond, you would have had most of your principal paid back already. If you had just a regular bond with no sinking fund, no terms, and the company goes bankrupt in year 29, then you don't get your par value back don't get any of your par value back generally in year 30 if there's no assets to disperse. So that's why these bonds with sinking funds are a little bit less risky. And that's why when banks or auto companies issue loans for automobiles or houses, they are basically term bonds where you're paying principal along with interest over the life of the bond. So it would be kind of interesting. Say you bought a house and all you had to pay was interest. And then on the 30th year of owning the house, you'd have to pay back the full principal value of the house. They don't do that, but that, that would be an interesting bond to kind of contemplate, a mortgage to contemplate, because if I buy a house today, say for, say I buy it for 300,000 euros, in 30 years, 300,000 euros is not going to be the same value it is today. So just that inflation eating away at that principal, paying it back 30 years from now would be a much smaller value of money. So that would be advantageous. But those types of mortgages would probably have much higher annual interest rates to compensate for that risk of that. Okay, so let's talk about secured and unsecured debt. Now, like I was talking about mortgages before, mortgages are a form of secured debt. And they're secured by the value of the home. Now, when we talk about senior or secure obligations, when we're talking about bonds, that means that they're backed by some specific property claim of the issuer. So the claim on the business, the claim on the real estate, and mortgage bonds are a good example of the secured debt, where they're secured by the by the real estate that the bonds are issued against. Now, a collateralized trust bonds, these are secured by some sort of financial assets owned by the issuer, held in trust by a third party. So they might say, okay, let's take, we have all these factories, we're going to put those in a collateral trust held by independent third party, and these will back up the bond. So if we default as a company, the bondholders will get these factories. Equipment trust certificates would be securing a specific piece of equipment. So for example, if a common piece of equipment, an airplane, could be sold on sort of an airplane loan. Now, the actual ownership of the airplane is in a trust. So if the company defaults on paying for the airplane, then the airplane will be used to pay back the lender. First in refunding bonds, there's a combination of a first mortgage and a junior lien bond. So bonds are secured by the first mortgage on some of the issuer's properties, and then maybe a second or third mortgage on other properties. So it's less secure, meaning it's not first in line to get paid back because it's secured by additional mortgages. And that's something that, companies can put on as properties or businesses increase in value, just like when homes increase in value, additional mortgages can be attached to it. That's a kind of a rare event, though, for bonds. Now, a junior bond would be unsecured, so that it's not backed by any promise of the issuer. Let me just say, it's backed only by promise that the issuer will repay. It's not backed by any property or any other assets. So when we say a debenture, we're talking a bond that is totally unsecured, meaning that there's no collateral backing up the obligation. So if the company goes bankrupt and there's no money left to pay after it pays all its obligations, you get nothing. A subordinate debenture is an unsecured bond whose claims are secondary to the debenture. So these are even lower on the list. And income bonds, these are junior. These are the most junior of all the bonds, and unsecured debts requiring that the issuer pay interest only if it earns a certain amount of income. So income bonds, basically the company has to be profitable and making money for them to pay interest on these bonds, and they're the least secure, but typically have the highest rate of interest return. Okay, so let's talk about bond ratings. Actually, I'm going to pause part 1 here, and I'll pick this up in part 2 of this lecture.